Welcome back to Finance Supergirl, your go-to source for investment insights. In today's episode, we're delving into the intriguing world of stock delisting. Delisting occurs when a publicly traded company's stock is removed from the exchange on which it was previously traded. This can happen for various reasons, such as regulatory violations, financial difficulties, mergers and acquisitions, or strategic decisions by the company. Delisting can have significant implications for both the company and its shareholders. Section 1. Understanding delisting. Delisting occurs when a publicly traded company's stock is removed from the exchange on which it was previously traded. This can happen for various reasons, such as regulatory violations, financial difficulties, mergers and acquisitions, or strategic decisions by the company. Delisting can have significant implications for both the company and its shareholders. For the company, delisting often signifies a challenging period and can damage its reputation. It may indicate financial struggles or regulatory non-compliance, leading to a loss of investor confidence. Delisting can also limit the company's ability to raise capital through public offerings. However, it's important to note that delisting doesn't necessarily mean the end of the company. Some delisted companies manage to restructure, recover, and relist on other exchanges in the future. Section 2. Effects on shareholders. Picture this. You're at a party, and suddenly the music stops, the lights dim, and everyone goes silent. That's how it feels when a stock gets delisted. As a shareholder, the first impact you'll likely experience is reduced liquidity. Without a public exchange to facilitate trades, finding willing buyers and sellers becomes more challenging. It's like trying to find a dance partner in an empty room. The bid-ask spread, the difference between the highest price a buyer is willing to pay and the lowest price a seller is willing to accept, tends to widen in the absence of active trading. This can make it more difficult to execute trades at favorable prices, potentially leading to higher transaction costs. Furthermore, delisting often triggers a decline in the stock's value. When a company's stock gets delisted, it sends a signal to the market that something significant has changed. Investors and traders reassess their expectations and adjust their valuations accordingly. The stock's price can take a hit, sometimes leading to substantial losses for shareholders. It's like being on a roller coaster that suddenly takes a sharp drop. However, it's essential to remember that the delisting itself doesn't determine the stock's long-term prospects. Shareholders need to carefully evaluate the underlying reasons for the delisting, the company's future plans, and their own investment objectives before making any decisions. Section 3. Examples of past delistings. Now, let's take a stroll down memory lane and explore some notable examples of past delistings. One such example is the delisting of Blockbuster, the once dominant video rental chain. In 2010, Blockbuster filed for bankruptcy, and its stock was eventually delisted. The rise of online streaming services, such as Netflix, and changing consumer preferences for digital content contributed to Blockbuster's downfall. The delisting of Blockbuster serves as a stark reminder of how quickly industries can change and how companies need to adapt to evolving market dynamics to stay relevant. Another prominent delisting event involved Enron, an energy company that infamously collapsed in 2001 due to massive accounting fraud. Enron's stock was delisted following the revelation of its fraudulent activities, which led to substantial losses for investors. The Enron scandal highlights the importance of robust corporate governance, transparency, and ethical practices in maintaining investor trust. It serves as a cautionary tale for investors to conduct thorough due diligence and be aware of the risks associated with investing in companies with questionable financial practices. Section 4. Options for shareholders. If you find yourself holding shares of a delisted stock, you have a few options to consider. One option is to hold onto the shares and wait for the company to relist on another exchange or go public again in the future. While this can be a challenging and uncertain path, some companies successfully navigate their way back to the public markets. It's like holding onto a rare collectible that may regain its value in the future. However, it's crucial to assess the company's prospects, its ability to address the issues that led to the delisting, and the potential risks involved in holding onto the shares. Another option for shareholders of delisted stocks is to sell the shares in the over-the-counter, OTC, market. The OTC market provides a decentralized platform for trading securities that are not listed on traditional exchanges. Delisted stocks can continue to be traded on the OTC market, albeit with lower liquidity compared to exchange-traded stocks. It's like joining a smaller, more intimate gathering where buyers and sellers can still engage in transactions. However, it's important to be aware that trading in the OTC market may involve higher transaction costs and increased counterparty risk. Investors should exercise caution and consider consulting with a financial advisor to navigate the OTC market effectively. Section 5. Lessons and takeaways. Lights, camera, lessons learned. The delisting drama offers some valuable insights for investors. One key takeaway is the importance of diversification. By spreading your investments across different asset classes, sectors, and geographies, you can mitigate the impact of any individual stock's delisting on your overall portfolio performance. It's like having a diversified cast of characters in a movie, so even if one actor doesn't perform well, the others can carry the show. Diversification helps reduce the potential risks associated with individual stocks and enhances your ability to weather unexpected events. Another important lesson is the need for thorough research and due diligence when investing in individual stocks. Understanding a company's financial health, competitive position, and industry dynamics can help you make more informed investment decisions. It's like being the detective who digs deep into a case before making a judgment. By staying informed and staying vigilant, you can better assess the risks and potential rewards associated with your investments. Conclusion. And that's a wrap for today's episode on stock delisting. Remember, delisting can have significant implications for both companies and shareholders. If you find yourself facing a delisted stock, take the time to assess your options, consider your risk tolerance and investment goals, and seek professional advice if needed. Stay tuned to Finance Supergirl for more valuable investment insights to empower your financial journey. Thanks for joining us today on Finance Supergirl. If you found this information helpful, don't forget to give this video a thumbs up and subscribe to our channel for more valuable personal finance tips and insights. Share your thoughts and questions about stock delisting in the comments section below. Until next time, keep investing wisely and embracing the exciting world of finance. Note: the content provided is for entertainment purposes only and should not be taken as financial advice. Always do your research and consult with a professional before making investment decisions.